Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 3 of 14, Margin of Safety, the 3 most important words in investing. From The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig. What if the entire secret of investing could fit in 3 words and you're already ignoring them?
It sounds a little bit like clickbait, honestly, like one of those late night infomercials.
Yeah, right. Like the 3 weird tricks bankers don't want you to know or something.
Exactly. But in this case, I mean, we are really talking about the absolute bedrock of financial survival.
We really are. And today is just a massive deep dive. We're unpacking chapter 20 of The Intelligent Investor. And honestly, looking at all the notes we have here, this feels fundamentally different than the previous lessons.
Oh, for sure.
Like the previous stuff, defining investment versus speculation or understanding inflation, that was all just the warm-up. This right here feels like the main event.
It is the main event. Benjamin Graham himself actually said that if you had to distill the entire secret of sound investment, the entire secret of basically not going or broke into a single motto, this is it.
Just 3 words.
Just 3 words. Because this isn't just about making money. It's really about the mathematical formula for survival in a world that is just inherently unpredictable.
Right. And I know I want to find that secret sauce, and I'm sure everyone listening wants to know, okay, what are the 3 words and how do I use them to get rich by next Tuesday?
Yeah, good luck with that.
Exactly. But looking at the source material and knowing how Graham operates, I have a really sneaking suspicion you're going to tell me it's not a magic trick at all.
It is definitely not a trick. It is a discipline. And it's a discipline that is surprisingly hard to follow because human nature just fights against it every single step of the way.
How so?
Well, it requires you to be arrogant enough to think you can actually analyze a complex business, but then humble enough to know you're probably totally wrong about the future.
That is a really tough balance to strike. You have to be confident and paranoid at the exact same time.
Exactly.
Okay, well, let's unpack this because section 1 of the chapter starts with a bit of a legend. A story from history, which I wasn't expecting in a finance book.
Right, so Graham opens chapter 20 with this retelling of an old legend. You have this powerful monarch, and he tasks a group of wise men to boil down the entire history of the world into a single phrase.
Which is a ridiculous request.
Totally ridiculous. They have to capture literally everything. All the human drama, the wars, the periods of peace, the famines, the golden ages, all of it.
How do you even begin to summarize 10,000 years of human chaos in one phrase?
Well, they work on it for a long time. They argue, they debate, they probably drink a lot of wine, and eventually they come back to the king with just 4 words.
And those words are...
It too will pass.
Wow. Which is actually incredibly profound when you think about it. It's sort of the ultimate check on your own ego.
It really is.
Because when things are going great, you shouldn't get cocky because this too will pass. But also when things are terrible and you feel like giving up, you shouldn't panic because this too will pass.
It covers literally every possible scenario in human history. And Graham, who, had a bit of an intellectual ego himself, decided he wanted to do the exact same thing, but for the world of finance.
He wanted the universal law of investing.
Right. He wanted to find the phrase that covers every single intelligent financial decision ever made by anyone. The "this too will pass" of the stock market.
And spoiler alert, he didn't pick buy low, sell high.
He did not. That's an action, right? It's not a principle.
He didn't pick find the next Apple or spot the trend.
Definitely not. Those rely on prediction.
He didn't even pick compound interest as magic, which is usually the default go-to answer for every finance nerd out there.
No, the 3 words he chose were margin of safety.
Margin of safety. I have to be completely honest with you here. It sounds so boring.
It sounds incredibly boring. Like it sounds like something a structural engineer says about a concrete retaining wall, right? Or a safety inspector wandering around a factory floor with a clipboard. It doesn't sound like Wall Street. It doesn't sound like getting rich.
And that is exactly why it is so unbelievably powerful. Because most people, when they come to the market, they expect the secret of investing to be all about prediction.
Right.
They really think the secret is knowing what the future holds just a little bit better than the next guy.
Yeah, it's always, I know that AI is going to be massive in 2026, so I'm going to buy these AI stocks. That's the intuition everyone has.
Or, I know who's going to win the election next month, so I'm betting heavily on renewable energy or oil or whatever.
Precisely. We all think we're prophets.
But that is the arrogance of prediction, and Graham's provocation here is huge. He claims that if you truly have a margin of safety, you do not need to predict the future.
Which is a wild thing to say in finance.
He literally says, The function of the margin of safety is rendering unnecessary an accurate estimate of the future. Rendering unnecessary.
Sure.
That is a bold, bold claim. Because obviously nobody can actually predict the future. We barely know what the weather's going to do next Tuesday.
Exactly.
So if there's a way to invest large amounts of money without needing a crystal ball, I am definitely listening. But before we get into the actual stock mechanics, Graham uses an analogy that I found incredibly helpful to visualize how this works. The roulette wheel.
Yes, the roulette wheel. This perfectly illustrates the mathematical edge. So think about a casino, right? Specifically American roulette. You have the numbers 1 through 36, half are red, half are black.
Right, so if I walk in and bet my money on red and it hits red, I double my money. It's essentially a coin flip.
Exactly. But you also have the green pockets on the wheel, the 0 and the 00.
The house numbers, the ones that ruin everyone's night.
The house numbers. Now let's just do the basic math here. If you bet $1 on a single number, say you put a chip on number 17, and you actually win, the casino pays you 35 to 1.
Okay, $35 for a $1 bet. That sounds like a really good payout.
It sounds great, but what are the actual odds of hitting that number? They aren't 1 in 36. They are 1 in 38.
Right, because of the two green spots, the 0 and 00.
Exactly. So the payout they give you is slightly less than the actual statistical risk you are taking. That tiny gap, that difference between the 35 to 1 payout and the 1 in 38 odds, that is the casino's margin of safety. It's the house edge.
Okay, I'm following the math.
Now ask yourself this. Does the casino know if the next spin is going to be red or black?
No.
Do they know if the next number is going to be 17 or 32?
They have absolutely no idea. It's just a little ball bouncing around on wood and metal. It's pure physics and randomness.
They do not know the future of any single spin. On any given Tuesday afternoon, a gambler might walk in off the street, bet his entire life savings on number 7, win big, and walk out the door.
And the casino just loses money on that specific transaction.
They lose big money. But do they panic? Do they shut off the lights and close the doors?
No, of course not. They probably offer him a free buffet to keep him there.
Right, because they aren't playing for one single spin. They are playing for millions of spins across hundreds of tables every single day. And over the law of large numbers, that tiny statistical advantage, that margin practically guarantees they will end up with all the money.
So the casino uses the margin of safety to transform utter uncertainty at the micro level, not knowing the next spin, into total certainty at the macro level, knowing their yearly profit.
Perfectly put. The casino is not gambling. The guy sitting at the table drinking the free gin and tonic is gambling. The casino is running a highly predictable business based entirely on mathematics.
So Graham is basically asking every individual investor out there, do you want to be the guy at the table sweating over the next spin, or do you want to be the casino relying on the cold, hard math? Well, obviously, I want to be the casino. The casino always wins and builds massive hotels. But how does an individual person actually do that? I can't just build a roulette wheel in my living room and invite people over. How do we stop being gamblers and start being the house when we're actually buying stocks in the market?
And this brings us right to the core concept. We have to clearly define what margin of safety actually means in the real-world context of buying a piece of a business.
Okay, so definition time. What is the margin of safety in the stock market?
The literal definition is buying an asset at a price sufficiently below its appraised value. And that appraised value is what finance people call intrinsic value.
Intrinsic value. See, that sounds a bit mystical to me. Like some hidden aura a company has. How do you actually pin that down?
It isn't mystical at all. It's just arithmetic. Let's put some real numbers on it to make it concrete. Let's say you're analyzing a local business, a chain of lemonade stands. Let's call them Big Yellow.
Good Big Yellow lemonade.
You sit down and look at their actual physical assets. The wooden stands, the commercial juicers, the inventory of lemons. You look at their historical cash flow, how much pure profit they pull in every single summer. You look at their bank debts. You run the numbers and you determine very conservatively that this entire business divided by its shares is worth $10 a share.
Okay, so based on the cold hard math, the intrinsic value is $10.
Right. Now, if you go to the market and buy that stock at exactly $10, you are paying fair value. If the future goes exactly as you planned, if the next few summers are hot and lemon prices stay perfectly stable, you'll make a completely fair return on your money.
But I have absolutely zero margin of safety.
None at all. Because what if next summer is unusually rainy and cold?
People don't buy lemonade in the rain. So earnings dropped.
Earnings dropped significantly. The stock tanks to $8. You just lost 20% of your money. Or what if your initial calculation was just slightly off? Maybe those commercial juicers are actually rusting out and need to be replaced next month.
So I thought the business was worth $10, but reality says it's only worth $9. And because I paid $10, I'm instantly underwater.
Exactly. Buying at fair value is inherently risky because you basically have to be perfect. Your analysis has to be perfect, and the future has to cooperate perfectly.
And we already established we can't predict the future, so I'm essentially gambling that the weather stays hot.
You are. But what if the market is panicking for some silly reason, and you can buy that exact same $10 business for $6 a share?
Well, then I have a massive $4 cushion.
You have a 40% margin of safety. Now think about why this changes everything. It matters because your initial calculation that it's worth $10 might still be wrong. Maybe you missed the rusty juicers and it's really only worth $8.
But because I only paid $6 for it and it turns out to be worth $8, I still made a $2 profit, even when I was wrong about the initial value.
Exactly. Your error was absorbed by the margin. Or maybe your $10 calculation was dead on, but that unexpected rainy summer hits and earnings get slashed in half. If you paid 10, you're in real trouble. But if you bought it at 6, the bad news is already priced in. You are likely still fine, or at the very least, you haven't permanently destroyed your capital.
This connects perfectly back to that grand quote you mentioned earlier, rendering unnecessary an accurate estimate of the future. You don't need to know if it's going to rain next summer if you buy it cheap enough.
It's the bridge analogy. Warren Buffett, who is Graham's most famous student at Columbia, loves to use this one to explain it.
Yeah, I love this analogy. Let's walk through it.
Buffett says, imagine you are a structural engineer and you are building a bridge over a deep canyon. You know for a fact that a 10,000-pound delivery truck needs to drive across this bridge every single day.
Okay, so the requirement is 10,000 pounds.
Right. So as the engineer you design and build that bridge to hold exactly 10,001 pounds.
Absolutely not. That would be terrifying. I would never drive a truck over that bridge.
But why not? I mean, the math says it holds. 10,001 is technically greater than 10,000.
Yeah, on paper, in a sterile laboratory maybe. But out in the real world, what if the truck driver had a massive lunch? What if the truck has thick, heavy mud caked onto all the tires, adding weight? What if there's a microscopic hairline crack in one of the steel beams that the inspector missed? What if a heavy gust of wind hits the truck right at the middle of the span?
Exactly. The engineering spec sheet is perfect, but the real world is incredibly messy and unpredictable. You simply cannot know all the future variables, so you don't build it for 10,000 pounds.
You build it to hold 30,000 pounds.
Yeah.
You massively over-engineer the thing.
You build a giant buffer. In structural engineering, they literally call this a factor of safety. In value investing, Graham calls it a margin of safety. You construct a bridge strong enough to hold a military tank, and then you only drive a light delivery truck over it.
That is such a vivid way to think about stocks. Because most people, honestly, they buy a stock purely because they have a story in their head. They tell themselves, this company is going to grow earnings by 20% next year. They're releasing this revolutionary new product. The Federal Reserve is going to cut interest rates, so the market will go up. They construct this elaborate house of cards narrative.
Right, and they are betting their hard-earned money on a highly specific, highly optimistic future. They are essentially driving a 10,000-pound truck over a 10,000-pound capacity bridge. If a single part of that narrative fails, if growth comes in at 10% instead of 20%, if the product is delayed by supply chain issues, if interest rates actually go up, the bridge immediately collapses and they lose their money.
So Graham is practically shouting at us across the decades, don't do that. Assume your story is going to go wrong. Assume the driver ate too many cheeseburgers. Only buy at a price where even if the earnings shrink and the product is late, you still don't lose your shirt.
Yes. You buy at a price where really good things can still happen, and if they do, you look like a genius and make a fortune. But where all the bad things are already baked into the price you paid, you want the coin toss to be heads I win big and tails I don't lose very much.
Heads I win, tails I don't lose much. I like that. Now, looking at the history here, Graham didn't actually invent this concept for the stock market, did he? The notes say he originally started applying this to bonds.
That's entirely correct. People forget Graham started out his career heavily analyzing corporate bonds back in the 1920s. And in the bond world, the concept of a margin of safety isn't theoretical. It's an explicit mathematical ratio. They call it interest coverage.
Let's break that down for people who might not trade bonds. How do you calculate the safety of a bond using interest coverage?
Okay, imagine a big railroad company in the 20s. They borrow a ton of money by issuing bonds so they can lay down new steel tracks across the country. And because they borrowed this money, they now owe, let's say, $1 million every single year in interest payments to their bondholders.
Okay, so $1 million is the hard bill coming due every year no matter what.
Right. Now let's look at their income statement. If that railroad company is earning $1.1 million a year in total profit, technically on paper, they can pay their debt.
Technically. But that only leaves them with $100,000 of breathing room. That is a razor-thin margin.
It's basically no margin at all. Think about it. A tiny economic recession, a 10% drop in freight, shipping, a brief labor strike by the rail workers, and boom, their earnings drop below $1 million.
And suddenly they default on their loans and go bankrupt, and the guy holding the bond gets completely wiped out.
It's an incredibly scary bond to own, even if they promise you a really high yield. You're constantly sweating. But contrast that with another railroad. What if the second company is pulling in $5 million a year in profit, and they also only owe $1 million in interest?
Well, then they have 5 times coverage.
Exactly. Their earnings could literally drop by 50%, which would be a total macroeconomic disaster scenario like the Great Depression, and they would still be earning $2.5 million. They can still easily write that $1 million check to the bondholders. The investor holding that bond is completely safe. That massive gap is the margin of safety. Graham simply took this cold, rational logic, which was totally standard practice for bond analysts, and looked at the stock market and asked why on earth aren't stock investors doing this exact same math?
It seems so incredibly obvious when you lay it out like that. Why wasn't everyone in the 1920s doing it?
Because stocks are incredibly seductive. Stocks promise infinite growth. Bonds just promise a fixed return and safety. People just get completely drunk on the idea of rapid growth, and they entirely forget to check the bridge capacity before they drive over it.
But there's a catch here, right? I mean, we have to go back to your casino analogy. The casino doesn't win on every single spin.
They certainly don't. And this brings up what Graham calls the correlative principle. The margin of safety is incredibly powerful, but it desperately needs a partner, a spouse, if you will. And that partner is diversification.
Because even if I do my homework right, even if I find a business intrinsically worth $10 and I buy the stock at $6, there's still a chance the company could turn out to be a complete fraud. The CEO could be cooking the books, and the real value is actually zero.
Exactly. The margin guarantees that you have a statistically better chance of profit than loss. It mathematically shifts the odds in your favor, just like the house edge at the casino. But on any single spin, any single individual stock investment, you can absolutely still lose your money. Bad luck happens. Massive lawsuits happen out of nowhere. A CEO runs off to a non-extradition country with the corporate treasury.
So if I find what I think is a perfectly safe, undervalued stock, and I dump my entire life savings into just that one company, I am honestly still gambling. I'm just gambling with slightly better odds than the next guy.
You are definitely still gambling. You're betting it all on number 17. But if you carefully select 20 different stocks, and every single one of them has a strong margin of safety, now you've changed the game. Now the law of large numbers kicks in for you. Just like the casino floor.
Because one of those 20 might turn out to be a fraud and go bust.
Right. And maybe 2 or 3 of them just stagnate and do nothing for a decade. But the statistical advantage applied across the whole portfolio becomes a near certainty of overall aggregate profit. The winners will dramatically outpace the losers.
Okay, so the ultimate formula to stop being the gambler and start being the house is margin of safety multiplied by adequate diversification.
That is the formula. If you strip away all the complex jargon and accounting terms in this entire book, that is the core operational algorithm Graham is teaching.
Okay, I love the theory. It sounds perfectly rational, but I want to talk about reality. I want to talk about what actually happens when smart people ignore this rule. Because reading through this chapter, the history books and Graham's own examples are just littered with absolute horror stories. And I always feel like we learn so much more from looking at the gruesome car crashes than we do from reading the safe driving manual.
Oh, the stories in this book are incredibly painful to read, just wealth evaporating overnight. But they are profoundly instructive.
Let's start with story number 1, the danger of good times. This specific point felt completely counterintuitive to me when I first read it. Graham explicitly says that the biggest losses for investors don't actually come from buying bad companies during bad economic times.
No, they don't. He says the chief losses come from buying low-quality securities during favorable business conditions.
Unpack that for me. Why on earth is a favorable economic condition dangerous? Usually we all think a booming economy is the safest time to be in the market.
Think about the mechanics of a boom. A rising tide lifts all boats right, even the rotting, leaky ones with giant holes in the hull. When the overall economy is absolutely roaring, almost every single company looks highly profitable. Money is cheap. The banks are handing out loans to anyone with a pulse. Consumers are spending like crazy.
So even a fundamentally terrible company, one with way too much high-interest debt or a completely flawed business model, can accidentally post decent earnings for a year or two just by being pulled along by the macro trend.
Exactly. And the unwary investor looks at those recent earnings and says, hey, look at this. They made a ton of money this year. The stock is going up. This is a totally safe bet.
They mistake current temporary prosperity for intrinsic long-term safety.
Perfectly said. They confuse a cyclical boom with permanent earning power. They only look at the rosy income statement, and they completely ignore the massive ticking time bomb on the balance sheet.
The notes we have highlight the Penn Central story. This is obviously a classic example from Chapter 17, but Graham brings the ghost of it back here as the ultimate warning of this exact phenomenon.
Penn Central was basically the Enron of its day. For people listening who might not know their railroad history, Penn Central was the largest single railroad in the entire United States. It was a massive, sprawling, highly prestigious American institution. It was actually the result of a mega merger between two titans, the Pennsylvania Railroad and the New York Central.
So we are not talking about some shady penny stock trading on the pink sheets. This was the pinnacle of corporate America.
Not at all. In 1968, the stock was trading at $86.50 a share. Practically everyone owned it. Mutual funds, pension funds. It was considered the ultimate widow and orphan stock.
Meaning it was supposed to be so incredibly safe and stable that you could put a helpless widow's life savings into it and never have to worry.
Right. If you walked down Wall Street in 68 and asked an average investor, is Penn Central a safe investment? They would have literally laughed in your face. They'd say, of course it's safe. It's the largest railroad on earth. The government relies on it.
And yet what actually happened?
Barely 2 years later, in 1970, the entire corporation was totally bankrupt. The stock went to essentially zero.
From $86 down to zero in 24 months. For the biggest railroad in the country. How does a collapse that massive even mathematically happen?
Because the margin of safety simply was not there. If you looked past the prestige and the size and looked at the actual math specifically, that exact interest coverage ratio we were just talking about, it was flashing bright neon red.
What are the numbers?
Their interest coverage was less than 2 times, meaning they were barely squeaking out enough cash to pay their massive debt obligations. Any slight hiccup in the economy, and they were dead.
But nobody cared because the economy was booming in the late 60s.
Right. Plus, Graham noted a massive red flag in their filings that everyone else just completely ignored. They literally hadn't paid any federal income tax in years.
Wait, hold on. Isn't legally avoiding taxes a good thing for a company? Everyone hates paying taxes. I'd love a company that pays zero tax.
Well, sure, nobody likes writing that check to the government. But think about the underlying accounting reality. Corporations pay federal taxes on their actual profits. If a massive company isn't paying any taxes for years at a time, it's usually because, according to the strict rules of the IRS, they aren't actually generating any real profit.
Ah, I see. They might be reporting a fake profit to their shareholders using aggressive accounting loopholes, but the IRS doesn't buy it.
Exactly. If the IRS says you owe zero, it strongly implies you made zero real dollars. It's a massive warning sign.
That is such a subtle but brilliant clue to look for.
But the investors completely ignored the arithmetic of safety because they were entirely seduced by the narrative of size and prestige. They had zero margin. They were joyriding a 20,000-pound truck over a 10,000-pound bridge just because the bridge had a really famous name painted on the side of it.
And the second the economy turned slightly negative, the entire structure collapsed into the river.
Precisely. And it wiped out billions of dollars of wealth.
Let's move to story number 2. This one is pulled from Jason Zweig's modern commentary at the end of the chapter, so it hits a bit closer to home chronologically. The dot-com bubble.
Yes, the growth stock trap. This specifically looks at a high-flying tech company called JDS Uniphase.
I vaguely remember that name from the late 90s. They made the actual physical fiber optic components for the internet backbone, right? The hardware that made the web work.
They did. They were a real company making real essential products. And in 1999 and 2000, the prevailing market narrative was the internet is going to change the future of humanity.
Which, to be fair, was absolutely true.
It was entirely true. We're recording this using the internet right now. The underlying narrative wasn't wrong, but the logic applied to the stock price became totally untethered from any mathematical reality.
Because as Graham constantly warns, growth stocks are incredibly dangerous if you price them for perfection. He explicitly says if you pay a premium for growth, you completely obliterate your margin of safety.
Right. Because if a stock price mathematically assumes the company's going to grow its earnings by 40% every single year for the next decade, and it ends up only growing by 30%, which is still phenomenal growth, the stock doesn't just go down a little bit to adjust, it absolutely collapses.
Why does it crash so hard if it's still growing at 30%?
Because the massive premium price you paid was entirely dependent on that extra 10% of exponential magic. Once the illusion of perfection is broken, the premium vanishes overnight.
So what did the collapse of JDS Uniphase actually look like for the people holding the bag?
JDS Uniphase fell 98.4% from its peak.
98.4%. That is genuinely hard for my brain to even comprehend. That's essentially a total wipeout.
Let me put the math in perspective for you. Jason Zweig calculated that if you bought that stock at the absolute top of the bubble just to break even, just to get back to zero return, you would need the stock to generate 43 consecutive years of 10% annual returns.
43 IMs. So if I bought it at the top in the year 2000, I am literally just getting my original principal back in the year 2043.
Yes, assuming the company even managed to survive that long, which in its original corporate form it didn't.
See, that isn't just a market correction. That is permanent capital destruction. That is your retirement savings literally evaporating into the ether, never to return.
And permanent capital destruction is the exact specific disaster that the margin of safety is explicitly designed to prevent. Because when you buy a hyped-up stock like that, priced at hundreds of times its actual earnings, you're essentially betting your life savings that absolutely nothing will ever go wrong for a decade.
You're betting on a flawless miracle.
And economic miracles are exceedingly rare in finance.
Okay, those are two incredibly depressing failures. We desperately need a win here to cleanse the palate. Show me what it looks like when the margin of safety principle actually works in real life.
Let's talk about the Burton-Dixie Corporation. This is story number 3, right from Graham's text.
Burton-Dixie. That sounds like a brand of paper cups from the 50s.
Close. It was actually a relatively obscure textile company making fabrics and bedding. Very unglamorous. Not high-tech. Definitely not changing the world.
Boring. I am already profoundly bored by this company.
Good. As a value investor, you should love boring. Boring usually means neglected, and neglected usually means cheap. Let's look at the exact numbers Graham lays out for this trade. The stock price on the open market was $20 a share.
Okay, $20 to buy a single share.
Now, Graham looked at their balance sheet to find the net current asset value.
Wait, pause right there. Let me make absolutely sure I understand what net current asset value actually means in English.
Sure, it's a crucial concept.
Does this essentially mean if you forcefully shut down the entire company tomorrow morning, you fire the CEO, you fire all the workers, you take all the inventory sitting in the warehouse and sell it for pennies to a liquidator, and then you take all that cash and pay off every single bank loan and outstanding debt the company owes?
Yes, exactly.
And after all that destructive liquidation, you just have a giant pile of cold, hard cash sitting on a desk. And if you divide that pile of cash by the number of shares, that is the net current asset value.
Yes. That is the ultimate worst-case liquidation value of their most liquid assets. It assumes the actual operating business is basically worthless.
Okay, and for Burton-Dixie, what was that per share cash value?
It was $30 a share.
Okay, so let me get this straight. I can go to the stock market and buy a share for $20. And that share legally entitles me to a literal pile of cash for $30.
Exactly. You are essentially buying a $1 bill and paying only 66 cents for it.
But wait, what about the giant textile factories they own, the heavy machinery, the real estate the factories are sitting on, the actual Burton-Dixie brand name?
You get all of that totally for free. Those assets aren't even included in the net current asset value calculation. You are paying significantly less than the value of the raw cash on hand. The factories and the business operations are just a free bonus lottery ticket.
That sounds completely illegal. or at least logically impossible. Why on earth would the market ever sell $30 of cash for $20?
Because the market is emotional. The market thought the company was boring. The textile industry as a whole was deeply out of favor. Everyone was chasing the hot, nifty 50 growth stocks of the era and completely ignoring the ugly, boring textile mills.
So Graham saw this discrepancy, and I assume he bought it.
Of course he bought it heavily. He loved these setups. He called them net-nets. And here is the absolute beauty of the margin of safety principle in action. Graham didn't need to know anything at all about the textile business.
Right. He didn't need to predict fabric trends.
He didn't need to know if polyester was going to replace cotton next year. He didn't need to analyze their management team. He literally just needed to know that 20 is a smaller number than 30. It is pure, unadulterated arithmetic.
And what was the actual result of the trade?
Within 3.5 years, the stock price corrected to its actual value and went up 169%.
Wow. That absolutely crushes the average market return.
Crushed it. With zero special insight, zero predicting the future, just relying on the margin of safety. He bought assets so incredibly cheap that even if the underlying textile business completely failed, the liquid assets protected his downside. And when the broader market eventually woke up and realized, hey, this literal pile of cash is selling for a bizarre discount, the price rapidly corrected upwards to meet the real value.
That example right there that perfectly captures the profound difference between investing and speculating. Speculating is buying JDS Uniphase because you have a vision of the fiber optic future. Investing is coldly buying $30 of cash for $20.
Perfectly stated. Speculation is inherently about what might happen in a hazy future. Investing is strictly about what is already verifiably there right now.
So I want to pull all of this historical theory directly into the present day. Because we are sitting here today. It is Sunday, February 22nd, 2026. And looking around the current market, it feels very much like the dangerous growth stock era Graham was warning us about. We have artificial intelligence fundamentally altering every industry. We have biotech companies essentially rewriting human DNA. We have crypto assets doing whatever they do.
We do. It's a wild time. And the broader market right now is overwhelmingly driven by grand narratives rather than strict arithmetic.
I feel like we have a massive priced for perfection problem on our hands right now.
We absolutely do. If you look at some of the most popular mainstream tech stocks today, I won't name specific ticker symbols, but just look at their price to earnings ratios. We are routinely seeing companies trading at 50 times, 70 times, even 100 times the current earnings.
And if you buy a stock at 50 times earnings, you are implicitly mathematically stating, I am 100% sure this specific company will utterly dominate its sector without any major roadblocks for the next 15 to 20 years.
Yes. You are willingly driving that heavily loaded 30,000-pound truck right over a bridge that is only rated for 30,000 pounds. You have left zero room for error.
And errors always happen.
Always. What happens if there's a sudden, massive regulatory change in Washington? What happens if the European Union decides to completely ban their specific AI training model over privacy concerns? What happens if inflation ticks up and interest rates spike again? Or what if a couple of kids in a garage release a slightly better, faster model next week and steal their market share?
The narrative breaks and the bridge collapses.
And that is the acute danger retail investors face right now. By chasing the hype, they have completely removed their margin of safety. They are relying entirely on a rosy, flawless future scenario. They are walking a very high tightrope without any safety net below them.
But there's another crucial angle to this that we need to touch on. The emotional buffer. We've talked a lot about the cold math today, but the margin of safety isn't just a financial equation on a spreadsheet, is it? It's deeply psychological.
It is arguably mostly psychological. Graham was a huge pioneer in behavioral finance long before it had a name. Think about it this way. If you do your homework and you buy a stock that you mathematically know is worth $10, but you only pay $6 for it because you demanded a margin of safety.
Okay.
And in the following month, some macroeconomic scare happens, the market crashes, and the quoted price of your stock drops from $6 down to $5. Do you panic and sell?
No. I mean, nobody likes logging in and seeing red ink on their screen.
Yeah.
But if I fundamentally know based on the assets that it's actually worth $10 and the market is now offering it to me for $5, I probably scrape together whatever cash I have and buy more.
Exactly. You are totally calm. You might even be thrilled. You treat it like a clearance sale on aisle 4. The price drop feels like an opportunity, not a disaster.
But conversely, if I buy a super hot AI tech stock at $100, purely because the momentum is strong and I think some greater fool will buy it from me for $200 next month. And I have absolutely no idea what the underlying business is intrinsically worth. I just know the chart is going up.
And then that stock suddenly drops to $80. What do?
I panic immediately. My heart rate spikes. I assume the grand narrative I bought into is fundamentally broken. I assume the trend is officially over, and I try to sell as fast as I can to stop the bleeding.
And you inevitably sell at the exact bottom. The margin of safety protects you from your own worst emotions. It gives you the deep internal conviction required to comfortably hold your position through inevitable market volatility.
And living here in 2026 with completely automated high-frequency algorithmic trading, basically moving markets by 10% in milliseconds based on a tweet, having that internal human emotional stability is honestly kind of our only remaining edge.
It really is. The algorithms are designed to chase momentum. They violently chase price action up and down. They're the ultimate follow-the-trend machines. But pure algorithms fundamentally struggle to recognize true value because assessing value requires complex human judgment and context. The intelligent investor ignores the noisy price action and quietly chases the discrepancy between the quoted price and the appraised asset value. That patience is the ultimate human advantage over the machine.
Okay, I'm completely sold. I'm a convert. I only want to be a strict margin of safety investor from now on. I only want to buy literal dollar bills for 50 cents. But as we get toward the end of our deep dive, we really have to address the massive elephant sitting in the room.
Yes, the GEICO contradiction.
Yes. This completely blew my mind when I read Jason Zweig's postscript to the book. Because Benjamin Graham spends literally 500 pages meticulously telling us to be incredibly disciplined, to mathematically diversify our portfolios, to only buy deeply discounted cheap assets, to completely avoid high-flying growth stocks.
He drills those rules into the reader's head in every single chapter.
And then right at the very end in the postscript, he basically freely admits that the single biggest, most successful investment of his entire life explicitly broke every single one of his sacred rules.
It is perhaps the greatest irony of Benjamin Graham's entire illustrious life.
Break the story down for us. What exactly happened with his fund in GEICO?
So the year is 1948. Graham's investment fund, which was called Graham Newman, was looking at a private company called Government Employees Insurance Company, which we all know today as GEICO. They eventually purchased 50% of the entire company for $712,000.
Okay. 700 grand for half a company. That sounds like a standard private equity deal.
But you have to look closely at the specific details of the transaction. First of all, making that purchase required putting roughly 20 to 25% of their entire fund's capital into this one single company.
25%. But Graham's rigid rule that he preaches constantly is a maximum of 5% in any one specific issue to maintain adequate diversification.
He completely broke his own diversification rule. He essentially bet the farm on one hand of poker. Second, GEICO was absolutely not a net stock. It was not selling for less than its liquidation value. They paid a pretty substantial premium over the book value to acquire it.
So he completely broke his strict valuation and margin of safety rule.
He did. And third, it was definitively a growth stock. It was an auto insurance company with a totally revolutionary new business model selling directly to consumers by mail, bypassing the expensive broker networks, and it was growing incredibly fast. And as we know, Graham generally hated paying up for future growth.
So to summarize, he concentrated his portfolio, he overpaid based on assets, and he bought a speculative growth narrative.
Sure.
He broke all his major rules. And what was the ultimate outcome? Did he lose his shirt and learn a lesson?
The investment generated a 562 times return.
562 times his original money. That is astronomical.
By 1972, the profits from that one single rule-breaking GEICO investment were actually worth substantially more than the combined profits of every single other careful, disciplined investment Graham had made over 20 years of running the fund.
Wait, are you serious? So all that meticulous accounting, all the clever bond arbitrage, all the boring Burton-Dixie net trades he grinded out.
All of it. All of those brilliant disciplined value trades combined were basically just a rounding error compared to the massive windfall from GEICO.
That is honestly really disheartening to hear as a reader. Or maybe it's liberating. I really can't decide. It feels a bit hypocritical, like he's saying, do exactly as I say in my book, but whatever you do, definitely don't do what actually made me rich.
Well, Graham, to his immense credit, actually acknowledges this glaring contradiction directly. He was intellectually honest enough to write in the postscript, and I'll quote it. He says, "One lucky break or one supremely shrewd decision, can we tell them apart, may count for more than a lifetime of journeyman efforts."
A lifetime of journeyman efforts. That's a very polite, poetic way of saying grinding out small, boring wins for decades.
It is. But let's play devil's advocate here for a second and analyze this. Why did he actually pull the trigger and buy GEICO? Was he just gambling blindly, or was he able to see a structural advantage that others couldn't?
Well, he clearly recognized that the direct-to-consumer business model gave them an insurmountable cost advantage over traditional insurance companies.
Right. He saw a massive qualitative moat. But here is the much deeper existential question. If Benjamin Graham hadn't been rigidly following his strict, boring rules for the other 75% of his portfolio all those years, would his fund have even still been in business in 1948 to make that bet?
Oh, I see exactly what you mean.
Think about his timeline. Graham survived the catastrophic Great Crash of 1929. He survived the agonizing depths of the Great Depression in the 30s. He survived the massive economic upheaval of World War II. He survived all of that completely unprecedented chaos purely because of his strict margin of safety. All that boring journeyman stuff kept the lights on and kept his capital intact.
So the strict margin of safety basically kept him alive and in the game just long enough to eventually get really lucky.
Exactly. The margin of safety isn't necessarily a magical formula to get super rich super quick. It is a vital survival mechanism that prevents you from dying financially while you patiently wait for the opportunity to take that one massive asymmetric swing.
That reframes it perfectly. Survival is the absolute non-negotiable prerequisite for ultimate success. Because if you blow up your trading account trying to buy growth stocks in 1930, you simply aren't around with capital to deploy when GEICO comes along in 48.
Precisely. You have to stay at the table to catch the winning hand.
So this perfectly segues into the major debate angle of this whole philosophy. The big critique that modern investors have is demanding total safety actually inherently risky in the long run. Because if you rigidly demand a huge quantitative margin of safety based purely on current assets, you are mathematically never going to buy Amazon in 1999. You are never going to buy Nvidia in 2018.
This is exactly the famous critique levied by investing legends like Charlie Munger and Phil Fisher.
Right. Charlie Munger famously refers to Graham's cheap net stocks as cigar butts.
He does, and it's such a beautifully vivid, disgusting image. Munger essentially says Graham constantly buying these dying, heavily discounted businesses is like a guy walking down a dirty street and finding a nasty, soggy, discarded cigar butt sitting in the gutter. It's totally disgusting, but he picks it up because it has exactly one free puff left in it. And because he picked it up off the street for free, that one single puff is pure 100% profit.
That is a very gross analogy, but it perfectly encapsulates the Burton-Dixie textile trade we talked about earlier, buying a clearly dying factory purely to liquidate the cash in the bank.
Exactly. Munger argues that hunting for cigar butts is just a terrible, exhausting way to live your life. You are constantly digging through corporate garbage. But more fundamentally, he argues that buying a fundamentally fair or mediocre company strictly because it is trading at a cheap price is actually a massive trap. Because time is the ultimate enemy of a mediocre business. If you hold a structurally bad business for 10 years, you are going to get a bad financial result, regardless of how cheap it was when you initially bought it.
Whereas if you pay up a little bit to buy a truly great, wonderful business like an Apple or a Costco time, is actually your best friend, because compounding does the heavy lifting for you.
Exactly. Munger's famous synthesis of this is that it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price.
So looking at the debate, side A is the Graham purist who says, I don't care if the company's wonderful or changing the world, I only care if it's statistically cheap. I want mathematical survival above all else.
And side B is the Munger critique, which argues that true lasting safety actually comes from business quality. A great dominant business with a massive competitive moat is actually vastly safer over a 20-year horizon than a cheap, dying business that is actively falling apart.
So can we actually synthesize these two sides? Is it possible to apply Graham's strict margin of safety to Munger's high-quality companies? Or are we just forced to choose between the two?
I think synthesizing them is exactly where the most successful modern value investing has evolved to today. You really don't look for literal cigar butts or net nets anymore because honestly, modern markets are too efficient with scanning software, they barely exist. Instead, you look for a truly wonderful, dominant business like a Microsoft or a Visa, but you don't buy it immediately, you patiently wait.
You wait for what exactly? A stock market crash?
You wait for a moment of temporary extreme market distress. You wait for a broad macroeconomic panic. You wait for a temporary, highly publicized scandal that drops the stock but doesn't ruin the core business. You wait for the Federal Reserve to quickly hike interest rates and scare all the algorithmic traders into selling.
You essentially wait like a sniper for the price to temporarily, violently disconnect from the true underlying value.
Exactly. You demand a strict margin of safety, but you demand it on the high-quality asset. You refuse to pay 50 times earnings for the great company. You simply wait however long it takes until the market panics and offers that exact same great company to you for 20 times earnings.
So you are still absolutely insisting on driving the truck over the massively over-engineered bridge, but you are refusing to do it until the toll booth dramatically lowers the entry fee.
Or you're making absolutely certain the bridge is constructed out of aerospace-grade titanium. That's the business quality aspect before you even attempt to drive the heavy truck over it.
I really, really like that framework. It bridges the gap perfectly. So we've covered the underlying theory, we've done the historical stories, we've wrestled with the contradictions. Let's get extremely practical for the listener. It is Monday morning. I am sitting at my desk drinking my coffee, looking at my brokerage account. I want to apply this. How do I actually start using this 3-word secret today?
The very first and most important step is a complete mental rewiring. The next time you look at a stock, you have to forcibly stop yourself from asking the default question, which is, how much money can I possibly make on this trade?
Which is incredibly hard because that is literally the first question every single human being asks. What's the massive upside here? Is this going to 10x my money?
You have to completely flip that script. Before you think about yachts and Lamborghinis, you have to start asking, what is my exact downside protection here?
How much money am I mathematically guaranteed to lose if I am totally wrong?
Exactly. You have to actively adopt the cold, calculating attitude of an insurance underwriter. Think about how an insurance company operates. They don't write a policy blindly hoping a house won't burn down. They calculate the exact mathematical risk and the cost if it does burn down, and they price their premium to explicitly protect their downside no matter what happens.
That makes perfect sense philosophically. But practically speaking, is there a specific physical test I could do at my desk?
Yes, there is. It's what I call the write it down test. It is a fantastic forcing function for discipline. Before you ever hit the buy button on any single asset, whether it's a tech stock, a piece of local real estate, or some new crypto token, you take out a physical piece of paper and a pen, and you physically write down your specific valuation of the asset.
Not the quoted ticker price, my calculated intrinsic value.
Right. You write down, I explicitly believe this entire business is worth $100 per share, and here's the exact math to prove it based on their current earnings, their tangible assets, and their current dividend yield. You literally have to show your work like a high school math test.
Okay, so I do the math and I write down it's definitively worth $100.
Then and only then do you look at the actual quoted market price. Is the market currently asking $95?
If they are asking $95, then I have mathematically no real margin of safety. That's a tiny 5% buffer. That's just statistical noise.
Exactly. So you absolutely do not buy it, you walk away. But what if you look at the ticker and the market in a panic is offering it to you for $60?
Well, now I am extremely interested because that is a massive 40% margin of safety below my calculated value.
But here is the ultimate catch, and honestly, this is the hardest part of the entire process for most people. You must be able to logically justify that $100 intrinsic value without relying on any highly optimistic predictions about the future.
Meaning I can't write down it's worth $100 because I firmly believe next year they're going to invent cold fusion and totally save the world.
Exactly. If you have to rely on an unproven miracle or a massive paradigm shift to mathematically justify your intrinsic value, you have absolutely no margin of safety. You are simply writing a speculative fiction novel.
The valuation has to be entirely based on the concrete reality of the shooter right now, or at the very least, a highly pessimistic, highly conservative view of the future.
Precisely. If you can physically, mathematically demonstrate a massive gap between the current price and the conservative intrinsic value, you confidently buy the asset. If you cannot prove that gap on a piece of paper, you immediately pass and move on.
I gotta say, that sounds incredibly restrictive. It honestly sounds like I'm gonna be sitting on my hands in front of my computer doing nothing a lot of the time.
You absolutely will be. You will end up saying no to 99% of the investing ideas that cross your desk. You will have to sit there in cash and painfully watch your friends and neighbors seemingly get rich overnight gambling on meme stocks and garbage crypto coins.
That is going to be psychologically painful. FOMO, the fear of missing out, is a very real, very powerful human emotion.
It is incredibly painful in the short term. But the 1% of the time you actually say yes, because the math aligns perfectly. It will be an investment that lets you sleep soundly through any market crash. And more importantly, it will be the discipline that keeps you financially alive in the game long enough to eventually find your own massive GEICO opportunity.
Financial survival has to come first. Winning the game comes second.
That is the true way of Benjamin Graham.
That was lesson 3 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.